Whether you're looking to safely store cash for a down payment on a future house, retirement income, or any other reason that you would want a safe yet guaranteed income, because CDs and Treasury bills are fixed income securities, it means that you are guaranteed a specific amount of money over a specific period of time that you actually own them. For example, let's say you put $10,000 into a 1-year CD that earns a 4% yield. That means after a full year, you would have gained an additional $400. Now, CDs and Treasury bills do have slight differences, so you may prefer one of them over the other, and let's first start off by breaking down the key differences between the two. For starters, CDs are typically issued through banks, credit unions, or select brokerage firms, where the typical time periods that you could select from could be as low as 3 months all the way up to 10 years. Where for Treasury bills, the most common places would be through the government's website, that is Treasury Direct, or certain brokerage firms like Fidelity, Vanguard, and Charles Schwab, to name a few. But understand that when you hear Treasury bills, the typical timeframes are going to be between 4 weeks to 52 weeks, and if you want a longer term duration, you would get Treasury notes that are between 2 to 10 years. And just for fun facts, if you wanted to get even longer, that would be Treasury bonds. That could be between 20 to 30 years. But the difference here is that with Treasury bills, you're not going to get paid any sort of interest payments because you're just going to get it all at the end when the T-bill matures. Where Treasury notes and bonds typically pay the fixed interest on a semi-annual basis, which is every 6 months. With CDs, it can range depending on the issuer that you get them from, but for a bank like Barclays, you can request interest withdrawals on a monthly basis without penalty. Now, whichever one you end up deciding with, just understand that depending on the investment, your minimum deposit requirement amount and the increments in which you can purchase them is going to be different. For example, Treasury bills on Fidelity have a minimum of $1,000 that is the increment in which you can purchase them. And in case you didn't know, with Treasury bills, when you see $1,000 of a face value, that is not what you actually pay to purchase a Treasury bill. That's actually what you get when the T-bill matures after the time frame. For example, if you wanted to purchase $10,000 into a 1-year Treasury bill that yielded a 4% return, that means it would cost you roughly $9,600, and after a full year, you would have turned that into a full $10,000. Besides that, with T-bills that are purchased through Treasury Direct, the difference here is that they have $100 increments, so that minimum could be $100, but the same concept applies when purchasing. And then for CDs, large banks like Marcus by Goldman Sachs has a $500 minimum deposit, and the amount can be exactly what you want. And then you could also compare with other banks like Basque Bank with a $1,000 minimum, or Barclays with no minimum amount required. I will mention that I'm just covering the key differences here. If you want to see each of these in extreme detail, I made many videos on them that I think you'll greatly benefit from, and I'll leave them linked in the description below. Besides that, with regular CDs, you're not going to have the same flexibility as you would with Treasury bills, or especially something like high yield savings accounts. But in the case that you had to sell your CD early, you would be charged a penalty, but that also depends on the issuer and how long you've had the investment. For example, with Basque Bank, CDs from 6 to 12 months may be subject to a 90 days worth of interest penalty, and for those longer than 12 months, it could be 180 days worth of interest. So with regular CDs, and I'll cover the examples and how to best utilize them shortly, but if you plan to buy them, you want to make sure that you are holding them through the entire duration. That is, unless you purchase no penalty CDs like these that allow you to sell anytime you'd like, and the nice thing here is that you're still guaranteed the interest rate from when you first bought them. And then for US Treasuries, the nice thing is that there are no penalties to sell them early, and if you're doing this on a brokerage firm like Fidelity, that's where I've done it before, they're very easy to sell. Also understand that many issuers allow you to set up a recurring investment into a similar CD or T-bill. Just be aware that you would not get the exact same rate. I'll go over some of the best options that you could compare with later in the video, but with CDs, understand that for the most part, they are backed by FDIC insurance, which protects your money in the event of something like a bank failure, which is typically insured up to $250,000 per bank per depositor. And then for T-bills, because they are US Treasuries, they're not going to be backed by the FDIC insurance program, but more so backed by the full faith and credit of the US government. Another really important thing to understand, especially if you're in a state with high income tax, is that CDs are taxed at the local, state, and federal level, where Treasury bills are exempt from state and local taxes. So if you are one in a state like California or New York, Treasury bills would definitely be the first option that you'd want to consider. But even though Treasury bills all around seem much better better, you still have to understand the differences and compare the options because there are times when CDs could still do you much better. An article I found interesting through Charles Schwab that I'll have linked in the description below shows the differences between the short-term maturities, which for around 6 months and under, T-bills would yield the most interest. But for the 1 year and above, it was calculated that CDs, at least at the moment, outperformed the alternative Treasury options. But because of all the options that are out there, you may actually be able to find one that is much better than the other, even if it is a short-term option, and I'll go over the best ways on how to utilize them later in the video. But before I get into that, here are the best options you could consider. First off, understand that rates are constantly changing, but if you want to look at the two different types of CDs, understand that regular CDs may offer slightly higher rates and longer periods, where no penalty CDs may have slightly lower rates, which also typically come with shorter time frames. For example, looking at some of the different options, you can see the highest yields for regular CDs currently is at 4.55% for a 1-month CD, but with these, you could get up to 48 months. That could be a 4.25% APY guaranteed. But if you filter over to the no penalty CDs, currently the highest is 4.45% over 4 months, but the longest option here is 14 months, and that's around 4%. These numbers constantly change, especially with the Fed cutting interest rates, so if you want to see the most recent updates for them, I'll have a direct link in the description below for you to check them out. Which, by the way, for all these options, all you need is $1 to get started. You can manage them all within one account. There are 0 fees, and this platform has over 1 million customers globally. Now, if you were looking for a more dominant bank, you may be interested in ones like these, such as Marcus by Goldman Sachs, or especially Basque Bank or Barclays, where you can get a 4.7 or 4.65% for a 6-month duration. I find these two very intriguing because if you compare them with another location like Fidelity, their current CDs for 6 months are around 4.35%, and then a Treasury bill is at 4.53%. I truly believe these are some of the top options in the market, and if you want to check them out, I'll also have a direct link to this in the description below. But in the case that you were looking strictly on a brokerage firm, looking at the rest of the data on Fidelity, you can see a 3-month CD could yield a 4.5%, where a 3-month Treasury bill could yield a 4.67%. So for that case, you would for sure want to go with a Treasury bill because you'd get a higher rate and you're exempt from state and local taxes. But if you look at the 1-year option for the CD, that would be a 4.45%, where the T-bill is 4.34%. And let's just say you want longer than 1 year, you'd now be getting Treasury notes, which depends on the time frame you want. But if we look at the 3-year option, it's roughly the same as a CD, but a 5 and 10-year option would be better through a CD. Or from looking through Treasury Direct for Treasury bills, they're currently offering a 4.73% return for a 4-week T-bill. A 26-week currently offers a 4.46%, or a 52-week currently has a 3.94%. Also understand that for all these investments, when you see the yields, they are going to be annualized, which means that you would have to hold the investment for an entire year to actually earn that rate. For example, if you earned a fixed 4% yield, but you bought a 6-month CD, that means your investment would grow from $10,000 to $10,200 after 6 months. Where if you were to have bought the same CD and held onto it for an entire year instead of 6 months, then that would have turned $10,000 into $10,400. So now that you understand many of the best options for these to compare with each other, let's now go over the best ways to utilize them based on generic examples. I think it's clear that for the most part, if you are looking for a short-term option, typically under 6 months, that Treasury bills would probably be your best bet. But I also highly recommend looking into all the options that are out there so you have a better understanding and idea of what you could potentially be getting into, and also remember to factor in the state and local taxes that you could be exempt from with Treasury bills. And that may or may not matter that much for you, and unless you're handling significant cash, the difference may not be that huge, because if we look at the previous example of Basque Bank earning a 4.7% yield on a 6-month CD or a 6-month Treasury through Fidelity, if you had $10,000 invested in this for the 6 months, that means the simple numbers you would end up earning would be 453 divided by 2, which is roughly $226, or 470 divided by 2, which is roughly $235. The difference is extremely small, and even if you had the same yield over an entire year, you would have earned $470 versus $453, And if you were in a state with a tax, let's say 5%, including local taxes, would be $470 times that 5%. Your total would be reduced by $23 to a total interest earned after the state and local taxes being $447. So the difference for that example is only a couple dollars, but if you're in a high state tax, just be aware to factor that in. I will say if you were in a state with very low tax or none at all like Florida, then you may actually do much better by purchasing a CD, but of course you just need to look at the different options that are out there. I would also suggest either way that if you are getting among the top options for CDs or Treasury bills, to just go with whatever is the most convenient for you that can still provide the best opportunity to get a return on your investment. And like I just showed in the previous example of $10,000, after the state and local taxes, the difference would really be only a couple of dollars. But if you do have cash ready to store away and you want to find the option that can give you the best return on your investment, a quick trick I would recommend when searching is finding the best option you have for each, and then looking up what your state and local taxes would be. For example, to visually see this, let's just say that the best CD that you can get right now is a 1-year term that's at 5%, but a Treasury bill is 4.5%. If you take the CD's 5% and times that by 5%, that would be 0.25%, which means the total after your state and local tax would be 4.75% for the CD, compared to the Treasury bill at 4.5%, of course not including federal tax. So above all, if you are in a state with pretty high taxes and you are using this in a normal taxable account, just be aware that with Treasury bills, you can avoid state and local income tax. Or if you're in a tax advantaged account where the taxes don't matter, or if you're in a state with low to even no income tax, you may want to look for the highest earning ones, and depending on your case, that could very well be CDs. Also be aware that the Fed is expecting to cut interest rates, so I highly recommend if you were considering these to look into it sooner than later, because you could lock in higher rates now before they drop. With that said, if you are interested to look at the options out there for CDs, I'll have 2 links in the description below for you to search through and get started, which if you decide to go through my links that are in the description below, it also helps me out and is greatly appreciated. Then, like I said earlier, if you want to learn more about each of these in much more detail, I'll have the other relevant videos I created like this linked in the description below, which while you're at it, don't forget to check out any of my free learning guides that I've created, and as always, don't forget that the like, subscribe, and notifications button for future content like this.